The United States has $36 trillion in debt. The debt ceiling is being hit again. Congress is fighting over whether to raise it. But here's what nobody's saying. It doesn't matter whether they raise it or not. The system is already broken. If you want to understand fiscal collapse before it reaches your portfolio, subscribe now and see the end game clearly. Let's establish the brutal reality that Washington refuses to acknowledge. The debt ceiling is a legislative limit on how much money the U.S. government can borrow. When the limit is reached, the Treasury Department can't issue new debt without congressional approval to raise the ceiling. This has happened dozens of times over the past 50 years. Every single time Congress argues, postures, threatens default, holds press conferences, blames the other party, then raises the ceiling at the last minute. Markets have learned to treat it as political theater, ignore the noise, buy the dip, move on. But this time is structurally different, not because the politics are more divided. They've always been divided, not because the stakes are higher. They've always been high, because the debt level has reached a point where the interest payments alone are consuming the entire federal revenue base. Let me make this absolutely clear. The U.S. government now pays more in annual interest on the national debt than it collects in individual income taxes. Interest payments in fiscal 2025, approximately $1.1 trillion. Individual income tax revenue, approximately $2.3 trillion. But total federal spending is $6.8 trillion. That means every dollar spent on defense, Medicare, Social Security, infrastructure, education, veterans benefits, everything except interest, is funded by borrowing or other revenue sources. This is not a sustainable fiscal position. This is a debt spiral. And raising the debt ceiling doesn't fix it. It doesn't address the underlying insolvency. It just allows the spiral to continue accelerating until the next ceiling is hit, which happens faster each time because the interest compounds and the deficit grows. Here's the mechanism that most people don't understand. When the U.S. government hits the debt ceiling, the Treasury Department can't issue new bonds to the public, but the government still has expenses. Salaries for federal employees, contracts with defense contractors, Social Security checks, Medicare reimbursements, interest payments on existing debt, money that must go out the door every single day. So the Treasury uses what they call extraordinary measures, accounting gimmicks that temporarily free up cash by suspending investments in federal employee retirement funds, redeeming existing securities early, shuffling money between accounts, halting certain bond issuances. These measures can buy time, usually 3 to 6 months depending on tax revenue and spending levels. Then, when Congress finally raises the ceiling, the Treasury immediately issues a massive wave of new bonds to replenish reserves and pay back the extraordinary measures. The cycle repeats. But here's what's changed. Each cycle, the debt grows larger, the interest burden grows heavier, the time between hitting the ceiling gets shorter. We're approaching the point where the extraordinary measures period won't be enough, where even a short delay in raising the ceiling causes actual missed payments. And once the U.S. government misses a single payment on a Treasury bond, a Social Security check, a defense contractor invoice, the credibility of the dollar as a risk-free asset evaporates globally and instantly. Think about what that means. The entire global financial system is built on the assumption that U.S. Treasury bonds are risk-free. That assumption underpins bank capital requirements, insurance company, reserves, pension fund allocations, central bank reserve holdings, money market fund structures, derivatives, pricing models. If treasuries are not risk-free, if there's genuine default risk, every one of those systems breaks simultaneously. Now layer in the political reality that makes this different from every previous debt ceiling fight. The Republican Party has a significant faction that genuinely wants to force spending cuts by refusing to raise the ceiling. They believe, rightly or wrongly, that the only way to impose fiscal discipline is to create a crisis that forces both parties to negotiate. The Democratic Party refuses to negotiate spending cuts as a condition for raising the ceiling, arguing that the debt was already incurred through bipartisan legislation and the ceiling should be raised cleanly. Neither side has an incentive to compromise before a crisis because compromise looks like weakness to their respective political bases. So the pattern is fight until the absolute last moment, then pass a temporary extension, then fight again in a few months. This worked when debt levels were manageable, when interest rates were near zero, and when global confidence in U.S. fiscal policy was unshakable. It doesn't work anymore. The debt-to-GDP ratio is over 120%, higher than at any point in U.S. history except the immediate aftermath of World War II. Interest rates are elevated and likely to stay elevated because inflation remains persistent, and the Fed can't cut aggressively without reigniting price pressures. Foreign creditors are already stepping back, China selling treasuries, Japan constrained, Middle East diversifying, and every debt ceiling fight now introduces the possibility, however small, that this time they don't reach a deal. This time, the U.S. defaults. Markets are starting to price in that tail risk. Credit default swaps on U.S. sovereign debt, essentially insurance against default, are trading at levels 300% higher than 3 years ago. Treasury yields show periodic spikes during debt ceiling standoffs as buyers demand risk premiums. Corporate credit spreads widen because if the U.S. government can't pay, corporations depending on government contracts definitely can't pay. The system is becoming fragile. Let's go back to 2011 and learn from what happened during the last serious debt ceiling crisis. The U.S. came within hours of a technical default. Congress was deadlocked. The Treasury warned they would run out of cash on August 2nd. At the last minute, literally on August 1st, Congress passed the Budget Control Act, raising the ceiling and implementing spending caps. Crisis averted. Markets breathed a sigh of relief, except the damage was already done. On August 5, 2011, Standard & Poor's downgraded the U.S. credit rating from 8AA to AA+ for the first time in history. Their reasoning: the downgrade reflects our opinion that the fiscal consolidation plan that Congress and the administration recently agreed to falls short of what, in our view, would be necessary to stabilize the government's medium-term debt dynamics. Translation: you raised the ceiling, but you didn't fix the underlying problem. Stock markets crashed. The S&P 500 fell 17% in 3 weeks. Treasury yields spiked despite the downgrade because investors fled to safety. Consumer confidence collapsed. Economic growth slowed. And that was when the debt was $14 trillion. Now it's $36 trillion. Now the political environment is more polarized, not less. Now foreign Treasury buyers are pulling back, not increasing purchases. Now the Fed's balance sheet is already bloated from years of QE, limiting their ability to intervene without reigniting inflation. The conditions for a full-blown fiscal crisis are worse than in 2011 in every measurable dimension, and yet the market is treating this debt ceiling fight as just another political sideshow that will resolve at the last minute. That's not rational analysis. That's normalcy bias. That's the assumption that because something has always happened a certain way, it will continue happening that way forever, until it doesn't. Here's the irreversible dynamic that's already locked in. Every time the U.S. government comes close to defaulting, it damages the perception of treasuries as risk-free assets. Once that perception is damaged, buyers demand higher yields to compensate for the risk. Higher yields mean higher interest payments on the debt. Higher interest payments mean larger deficits. Larger deficits mean more borrowing. More borrowing means higher debt. Higher debt means the next ceiling fight comes sooner and with even higher stakes. It's a doom loop, a fiscal death spiral. And the only ways out are: Option 1, massive spending cuts, politically impossible, entitlements are untouchable, defense is untouchable, interest must be paid. Option 2, massive tax increases, politically impossible, no constituency supports it, would crater the economy. Option 3, inflate away the debt, print money, let inflation reduce the real value of debt, destroys the currency, and punishes savers. Option 4, default or restructure, destroys credibility, crashes markets, triggers global crisis. There is no fifth option. The political system will avoid options 1 and 2 until the absolute last moment because they require political courage and inflicting visible pain on voters, which means the endgame is either Option 3, inflation debasement, or Option 4, default restructuring. Both outcomes destroy the dollar's value in real terms. Both outcomes validate the strategy of holding hard assets instead of dollar-denominated financial assets. Both outcomes trigger the repricing of gold and silver to reflect their role as monetary insurance. The debt ceiling fight is not the cause of the crisis. It's a symptom of terminal fiscal disease, and the disease is already in the late stages. So what does this mean for you personally and immediately? If you hold Treasury bonds, directly or through bond funds, you are lending money to an insolvent borrower that cannot credibly promise to repay you without debasing the currency. The risk-free asset is not risk-free. It's a leveraged bet on dollar stability and U.S. government solvency. If you hold cash in dollars, you are holding the liability of that same insolvent government, backed by nothing except the promise not to print too much. That promise is already broken. The money supply has exploded. Inflation has returned. Real interest rates are negative. Your cash is losing purchasing power every single day. If you hold dollar-denominated financial assets, stocks, bonds, REITs, you are betting that the U.S. fiscal crisis resolves without currency collapse or market crash. That might happen, but it's not a safe bet. The investors who recognize this reality are not panicking. They're not selling everything and buying canned food. They're methodically, systematically reducing exposure to dollar-denominated financial assets and increasing exposure to assets that hold value independent of government solvency. Gold, silver, real estate in stable jurisdictions, productive businesses with pricing power and international revenue, commodities, energy infrastructure, assets that generate real cash flow or have intrinsic utility regardless of whether the U.S. government can balance its books. Not because they're pessimists, because they're realists. and the reality is that the US government is insolvent by any honest accounting standard. The only thing preventing immediate crisis is the willingness of creditors to keep lending and the Federal Reserve's willingness to print money to buy bonds if creditors stop. Both of those conditions are weakening. Let's talk about what institutions with actual information are doing right now. Foreign central banks, historically the largest and most stable buyers of US Treasuries, are net sellers. China has reduced Treasury holdings from $1.3 trillion in 2013 to under $800 billion today. That's a $500 billion reduction. They're not selling because they hate America. They're selling because they see the fiscal math and they're diversifying reserves. Japan is under enormous pressure to support the yen and can't keep recycling trade surpluses into Treasury purchases the way they did for 40 years. Saudi Arabia and Gulf states are diversifying reserves into euros, yuan, gold, and other assets. Even traditional U.S. allies are quietly reducing Treasury exposure. This is not speculative behavior. This is strategic portfolio reallocation by entities with trillion-dollar balance sheets and multi-decade time horizons. They see the U.S. fiscal trajectory. They understand the math. They know the end game, and they're repositioning before the crisis. Domestic institutions are doing the same thing, just more quietly to avoid spooking markets. Pension funds are increasing real asset allocations, commodities, infrastructure, farmland, from 0% to 2% to 5% to 8% of portfolios. When you're managing $500 billion, an 8% allocation is $40 billion flowing out of financial assets and into tangible things. Insurance companies are moving into inflation-protected securities, floating rate debt, and hard assets because they're modeling what happens to their bond portfolios if yields spike or the dollar debases. Endowments, Harvard, Yale, Stanford, have been rotating out of long-duration government bonds and into alternative investments for years. The smart money is moving, not dramatically, not publicly, but persistently and directionally, away from unsecured claims on government solvency, toward assets with intrinsic value. Here's the moment of absolute truth. The debt ceiling fight is not a political drama, it's a symptom of terminal fiscal disease. The United States government is spending $2 trillion more per year than it collects in revenue. That gap is not closing, it's widening. Every year, the interest on the debt grows, consuming more of the budget, forcing more borrowing, accelerating the spiral. At some point, and we don't know exactly when, but we know it's coming, the market loses confidence. Not in a single administration, not in a single policy, not in a single political party, in the entire fiscal architecture of the United States government. When that happens, one of two things occurs. Scenario 1, Treasury yields spike. If buyers demand 6%, 7%, 8% yields to hold U.S. debt, asset prices across the board collapse. Stocks crash because discount rates rise and corporate borrowing costs spike. Bonds crash because yields are rising. Real estate crashes because mortgage rates hit double digits. Trillions in wealth are destroyed. Pension funds become insolvent. The financial system faces existential crisis. The Federal Reserve is forced to intervene with unlimited QE to cap yields and prevent total collapse. But that unlimited money printing reignites inflation, destroys dollar purchasing power, and triggers the global shift to alternative reserves we discussed in Video 5. Scenario 2, the Fed caps yields preemptively. They implement yield curve control or unlimited QE before markets force them to. Asset prices stabilize. The immediate crisis is averted, but the cost is dollar credibility. If the world sees that the U.S. cannot allow market-determined interest rates, that the entire system depends on Fed manipulation and money printing, trust in the dollar as a neutral reserve asset collapses. Foreign central banks accelerate diversification. The dollar loses reserve status through abandonment rather than crisis. Both scenarios end with gold and silver repricing sharply higher. Both scenarios validate hard asset positioning. The only question is which path we take and how fast it happens. Here's your action plan. You reduce Treasury exposure. If you own government bonds or bond funds, you sell or rotate into shorter durations that reduce interest rate risk. You reduce cash holdings to operational minimums. Keep 3 to 6 months' expenses in cash. Everything else gets deployed into productive assets. You build positions in physical gold and silver, 10-15% of liquid net worth, allocated storage or personal possession, not paper ETFs that settle in cash during crises. You consider international diversification, not to evade taxes, that's illegal, but to reduce geographic concentration risk. Some assets held in Singapore, Switzerland, Canada, Australia, stable jurisdictions with rule of law and fiscal discipline. You prioritize assets that generate cash flow in multiple currencies, businesses with international revenue, real estate in growing markets, infrastructure that produces necessary services regardless of which government is in power, and you prepare mentally for the political theater to continue until it doesn't, until the day the ceiling isn't raised in time, or is raised, but triggers a bond market sell-off anyway because the underlying insolvency becomes undeniable. Because that day is coming, The only question is whether you'll be positioned for it. $36 trillion in debt, rising every single second. $1.1 trillion in annual interest payments, more than we collect in income taxes. A political system that can't stop spending. A debt ceiling that gets raised every time, until the time it doesn't, or the time it does, and the market doesn't care anymore because the underlying insolvency is too obvious to ignore. The fiscal crisis is not coming, it's already here. It's been here for years. We've just been pretending it isn't because the consequences are too frightening to confront. But reality doesn't care about comfort. The math doesn't work. The debt spiral is accelerating. The ceiling fights will get more frequent and more dangerous. And the only question is whether you'll recognize the end game before your portfolio does. Because once the market figures it out, once yields spike, or the Fed goes all in on money printing, the repricing is instant, gold gaps higher overnight, the dollar falls, and the people asking what happened are the ones who assumed the system was permanent. The debt ceiling is a symptom, the disease is insolvency, and the cure is either default or debasement. Position accordingly.